Good morning, everybody. Welcome to the UHY and Brabners Structuring the Deal webinar this morning. Apologies for my croaky voice. I've had a COVID test and I'm absolutely fine. I think it's just down to having a emergency at home. So we're joined by some expert panelists today from both UHY and from Brabners. And the objective of this 1 hour this morning is to give you an insight into what's been going on in the transactional market for the last 3 years. Talk to you about different types of transaction structure that might be relevant to your business, and also just looking at the key considerations within a transaction, whether that be from a taxation perspective or from a legal perspective. So anybody who's got any questions, I believe you can drop them into the questions box, and we can pick them up at the end of the webinar. Hope it's informative, and obviously if anybody does have any questions that you want to direct to any of the panelists, please feel free to get in touch with us individually, and our contact details are at the end of the presentation. So moving swiftly into my first slide, the current M&A landscape over the last 3 years. So 2019, I think, for the majority of corporates was a good year. I think from the clients that we look after from an accounts perspective had a very good year, and there was real good momentum in the marketplace. There was a lot of transactional activity, there were good multiples being paid, but then obviously March 2020 hit us, COVID, and I think that was obviously a real tough period for a lot of businesses over that initial 3-month period. There's been an awful lot of government support that has been pumped into businesses, which has been fantastic in one regard, and it's certainly helped businesses through that initial period. But it's also really helped the financial results when we're looking at the full year for 2020. So I think businesses in general looked at a number of things during that COVID period. So there was cost-saving initiatives implemented across a lot of businesses. I think it was an opportunity for entrepreneurs and owners to look at the structure of their business, look at the processes within their business, and really rationalise areas that perhaps weren't core to them anymore. Transactionally wise, majority of transactions stopped, as you can imagine, which was tough for us, but obviously that's kind of the way it was. I think a lot of businesses also looked at new service lines, looked at differentiating their business model, looked at new products that they could implement into their customer base and how they could diversify. And I think the final thing that we've definitely seen is the digital strategy within businesses has really evolved, and I think the focus of that online place for a lot of businesses has been kind of very, very important to businesses. And that 3-month period that everybody had, those proactive businesses really got into that area and have really transformed their digital strategy. So I think the back end of 2020, transactional activity did start to pick up a little bit again. People had a good year. People have reported strong results from the accounts that are starting to flow through from 20. And all in all, I think when you reflect back on it, what could have been a categoric disaster for a lot of businesses actually turned into a reasonable outcome. Moving into 2021, I think it continues to amaze, really. We've come out of the lockdown. I think there are some sectors that have been hit harder than others. It goes without saying, hospitality, entertainment, tourism, maybe some of the high street. That has been a really tough area and remains a challenging area, even though there are kind of green shoots of recovery coming through. As we go into the winter months, we're not sure what that's going to mean for everybody. I think the one thing that's really surprised a lot of people is when we're looking at the management accounts of a lot of businesses across all sectors, there's been record performance and profits. Despite everything going on in the economy out there, businesses still remain strong and are performing. And whether that's because people are spending more, because they're not going away, we're not really sure. But at the moment, there's certainly a good feel in the corporate environment. And to be honest with you, at the moment, we can't see any sign of it easing. Yes, there are tax increases coming. We've seen the national insurance piece that was announced last week. We've obviously got the autumn statement coming. So, yeah, there is a likelihood that things might get a little bit tougher, but certainly it's not going to be a knee-jerk reaction, in our opinion. And the final point on this slide is never have we seen so much cash in businesses. hence there's a real kind of pent-up demand coming into the M&A market as people look at what they can do with their cash that's excess within that balance sheet position. Next slide, please. So what's going on in the deal market? I think one thing that we're definitely seeing is a real boom in that tech space. I think obviously going back to that discussion earlier around the digital marketplace. So I mean, we're seeing recurring fee multiples of 5, 6, 7 times in that marketplace. And when you're looking at EBITDA, I think the highest we've seen is 27 times EBITDA in the tech space for the right business with a strategic buyer. So from my perspective, I've never seen multiples as strong as that before, and they are continuing to deliver at those levels. So there's a real opportunity there. I think there's still a pent-up demand for good businesses in the generalist market. There's a lot of consolidators, the bigger businesses out there looking to bolt on. There's also a substantial number of PE-backed businesses that perhaps the PE journey might typically be kind of 5, 6 years, and 2 years of that has been affected by COVID. So there's a timeline implication on that. So again, we're seeing a lot of activity in that area. And all of those kind of active players in the market is ultimately driving value. So there is an opportunity at this moment in time to really kind of push that value expectation a little bit higher. Obviously, we'll come on to it probably in the tax section, but capital gains does still remain under threat. The autumn statement is going to be one to watch on the 27th of October. Will capital gains be looked at again, and will that impact an entrepreneur's exit value that they get net cash? I suppose my final point is we do seem to be in this little bit of a bubble at the moment, and when will that bubble burst? No one's sure. Timing's everything with transactions, but at the moment it does appear that we are in this kind of purple patch that's remaining very, very strong. Next slide, please. So before we go into some of the intricacies of the deal itself and the structures within the deal, there are 4 types of deal structure to consider. A trade sale, which I think the majority of people will be familiar with, whereby you are simply selling your business to a third party, perhaps in your sector or a complementary sector. Private equity, now that could be selling to a business that already has private equity investment, is looking to grow their portfolio, or that could also be looking to bring a private equity investor into your business for you to perhaps exit partly, and to bring a partner in to help you grow and scale the business with some expertise. That private equity market is really, really pushing on, and there's a lot of activity in that space. There's a lot of money out there. So again, it's an exciting and slightly different option for business owners to consider. MBO and MBI, so management buyout, where you sell to your existing management team. That might be through funding yourself as a director and leaving some low notes in there. But again, selling to the people that you know run the business for you today can be quite a nice way of an elegant exit. Or an MBI, which is slightly more uncommon, but whereby a management team come in and buy into the business and ultimately buy you out over a period of time. And the final one is deferred consideration, which again will be covered in a little bit more detail further on in the webinar, but typically trying to maximize deal value on day one as a total consideration, but being flexible with the payment profile, so enabling you to get that extra cream on the top of the cake, but taking the risk and allowing the buyer to pay it over a deferred period. Quite often in the management buyout structure, you would see that because the liquidity within the business and the debt that the management team are able to raise can sometimes be restricted. Next slide, please. I'm on to negotiating the deal now, so I will pass over.
Thanks, David. That was really useful, and it's interesting to see some of the trends coming through post-pandemic. It's great to see how resilient our UK businesses are, even through the pandemic. For those that don't know me, I'll firstly begin by introducing myself. I'm Mairead Platt, and I'm an associate solicitor in the corporate department at Brabners. Now, previous webinars, we discussed how to get your business in the best shape for sale, and we also covered exit options such as trade sales, management buyouts and buy-ins, etc. Today, I'll be focusing on the negotiations of a trade deal, and we'll be discussing common deal structures in business sales and acquisitions, which should hopefully assist you when negotiating a deal. Next slide, please. As David has just covered, it's important to understand the current deal market and recent merger and acquisition activity, as it will guide you in your negotiations and assist in considering trends and opportunities. Firstly, it's important that when negotiating a deal, any agreed terms are recorded in a letter of intent or heads of terms. Although heads of terms aren't legally binding, they can assist in evidencing the parties' intentions and will document the agreed terms and any timetables for negotiations. If there are any key conditions to completing the deals, for example, any reports, tax clearance, or other approvals to be sought or obtained, the heads of terms can assist by clearly identifying those conditions and documenting the obligations on each party to ensure that those conditions are satisfied. It can also be useful to set out potential completion dates and anticipated timetables for the deal. And the heads of terms can often act as a framework for the negotiations and can help focus the parties' discussions to ensure negotiations don't drag out unnecessarily. Heads of terms are also important for both the buyer and the seller, as they often include binding commitments such as exclusivity for the buyer or confidentiality provisions in favour of the seller. Some parties can also agree to break fees or other deal protection measures which would be binding in the heads of terms. Exclusivity is important to a buyer, as it will prevent the seller from negotiating with other parties for a certain period, and that will give the buyer time to consider the deal and negotiate the terms without the pressure or fear that the seller could finalise a deal with another party. On the other hand, the seller will want to include confidentiality provisions, and that will prevent the buyer from using any information it's obtained during negotiations for any purpose other than the deal. The seller is likely to disclose confidential information to the buyer, and the contents of the heads of terms are likely to be commercially sensitive too. So as a result, the seller will want to ensure that all information is kept confidential. The heads of terms will also need to document the agreed purchase price and the structure of the deal, and there are a number of common ways of structuring the purchase price, such as cash payment on completion, deferred consideration, buyer loan notes, or various price adjustment mechanisms, including lockbox and earnouts. The most straightforward way of structuring a deal will be for the buyer to pay the purchase price in full on completion. And this will often be the most preferred structure to a seller, as it provides immediate cash without any uncertainty or risk. However, a buyer may be reluctant or unable to agree to cash on completion, and it might have based its offer on various financial assumptions or might not agree on the valuation at all. As a result, a buyer might want to negotiate a price adjustment mechanism, which would result in the purchase price being adjusted up or down depending on the agreed structure. In most deal negotiations, the purchase price is based on the most recent financial statements of the target company. And as a result, the buyer will only be in possession of historic financial information. So it might require that confirmation that there's been no significant changes to the financial position since the date of the last accounts. To manage this, completion accounts can be prepared after completion has taken place, which will show the financial position of the company as at completion. Depending on the price adjustment mechanism agreed, the purchase price will then be adjusted up or down on the basis of the completion accounts. A less common price adjustment mechanism is known as locked box. Although we have seen an increase in parties adopting this deal structure in recent years, so it is becoming more popular. A locked box pricing mechanism is an alternative to a price adjustment based on completion accounts. The purchase price will ordinarily be calculated prior to completion using a recent balance sheet. And rather than a post-completion price adjustment, the parties will instead agree to any leakage between the lockbox balance sheet date and completion. The agreed leakage items are a commercial matter for the parties to agree, but often include things like dividends, management fees, and transactional costs. In the next couple of slides, I'll cover two common deal structures in more detail, focusing on deferred consideration and earnouts. Next slide, please. As explained earlier, the most attractive structure for a seller is usually the purchase price to be fixed and payable in full on completion, as it provides the seller with certainty and is the most straightforward structure. However, not all buyers will have funds to pay in full and may only be able to pay part of the purchase price on completion. As a result, the parties might agree to pay the purchase price in instalments and defer some of the consideration to a later date. There is an element of risk in agreeing to a deferred consideration structure, as the buyer might not pay the deferred element on time or at all. So a seller should therefore carry out its own financial due diligence against the buyer if deferred consideration is accepted, to ensure that the buyer is in a financially strong position and there aren't any concerns of the buyer's ability to pay the deferred consideration at a later date. A seller should also seek additional protections against the risk, and we would always advise on including a payment acceleration clause as a minimum. This will allow the seller to demand immediate payment of the deferred consideration in certain circumstances, such as the buyer failing to pay on time or the buyer becoming insolvent. We would also look to include a default interest clause to allow for a higher rate of interest to accrue in the event that the buyer fails to pay the deferred consideration on time. A seller should also look to negotiate some form of security for the buyer's obligations, and my colleague Richard will be discussing security over deferred consideration later in the webinar. An alternative to deferred consideration and a common form of non-cash consideration involves the buyer issuing loan notes to the seller. A loan note can be used to defer the buyer's obligations to pay at a later date when the loan notes are redeemed in full. The loan notes will be used to evidence the existence of a debt and would essentially mean that the buyer is borrowing part of the purchase price from the seller. Loan notes may be preferred by the seller, as the gain on disposal of the shares could be deferred until the tax year in which the loan notes are sold or redeemed. However, I'm not going to be covering loan notes in any detail today, and any tax implications will be discussed by Helen later in the webinar. Next slide, please. Another type of price adjustment mechanism is known as an earnout, which involves the purchase price being calculated based on post-completion performance. As with the other price adjustment mechanisms, the earnout structure and calculation of the earnout will very much depend on what's agreed between the parties. Earnouts are most typically used when the buyer and seller can't agree on the value of the target company, or where the seller is optimistic about the company's future performance and prospects. If an earnout structure is agreed, it's important that the seller continues to be involved in the business post-completion so that they have an element of control over future performance. Continued involvement from the seller alongside an earnout structure can also be used as a mechanism by the buyer to retain sellers if they're key to the business, and also incentivise them to maximise the profitability of the business. My colleague Trishna will be discussing ways in which a seller can be retained in the business later in the webinar. There are advantages to an earnout for both the buyer and the seller. For the seller, they can reap the rewards of selling a profitable business, and being retained in the business post-completion could give them the opportunity to be involved in a larger corporate group. From the buyer's perspective, an earnout will provide a more accurate valuation and will avoid the buyer from paying above the true value of the business. An earnout can also overcome cash flow issues for the buyer, as it acts as a way of deferring the payment to a later date. However, earnouts aren't suitable for everyone, as they don't provide for a clean break from the business. And so sellers who are eager to retire might not be willing to continue in the business after completion. Also, earnouts might not be the most tax efficient structure for a seller, something which Helen will discuss in more detail later in the webinar. For now, I'll pass you over to Richard, who will be discussing security for a buyer's payment obligations. Thanks.
Thank you very much, Mairead. Hi, I'm Richard Cowan. I'm a banking and finance partner at Brabners. I'm going to talk about deferred consideration security, or vendor loan note security, but we're here for the purpose of today, deferred consideration security. So look, we've covered structures for vendors to get paid, whether via deferred or under an SPA or via the issue of loan notes. We now need to consider how to protect those payments through the use of appropriate security. For today's webinar, for my bit, I'm assuming that the vendors are securing deferred consideration, as you can tell by the title. And the first question really to ask is, well, why do we want security? It might sound like an obvious question, but it's worth reminding ourselves that the reason security is granted is to ensure that the vendors are bumped up the pile ahead of unsecured creditors in the case the business gets into difficulty. As a rule of thumb, the vendors don't really want to have to enforce the security. They might consider the security is to therefore act as an incentive for the company business to make payments. Because in reality, would a vendor want to accelerate payments if one payment is missed? The simple fact is, if you don't take your cash on completion, there is always that risk. You're always slightly rolling the dice as to what money there'll be in the cash in the business and how successfully it will perform after you've exited. So the commercial numbers need to reflect that, I would say. The starting point, though, on this is really actually going to sort of intercreditor relationships. So to get straight stuck into that almost in a brief way, if you've got a senior lender involved at or immediately after completion, which will have security and debt in the business, you have to consider that because it will have an impact on your vendor who's taking deferred and taking security. In almost all cases, there would be an intercreditor agreement, and there are three key areas to consider on that. One would be ranking. Well, clearly the senior lender first and the vendor second. Permitted payments is another key area out of the three, which is that there is generally a block on payments to the vendors other than permitted payments, subject to certain criteria. Usually no events of default occurring, a look forward certificate being provided showing that there's compliance with financial covenants, and often no stop notice being issued by a senior lender. And the third area for intercreditor of key importance is enforcement rights. If you've got your security, you've got to be able to enforce it, and that's a key thing as to why the senior lender relationship is vital here. The reality is that senior lenders are generally not going to want your vendor who's got security and debt still due to them to bring down the pack of cards. So generally speaking, I've found that the vendors will be able to make demand for payments due under an SPA for the deferred, but taking enforcement action may well be restricted. The intricacies of that and the permutations of that are for probably another day, another session. But in terms of the security itself, and let's assume for today that we are taking security that can be enforced. The first would be a share charge. Well, if the starting point is that you're looking to exit the business, then you need to consider whether you really want to take share security, because the options are that if the payments aren't made, you either find yourself back in the position you were in, which is with the shares again, or going through a process to sell the shares. And of course, that's selling shares in a private limited company. So the consideration for share charges is, you want to have do you have any continuing involvement or visibility of the business? Because you may, if you're not involved, be taking a bit of a punt on how the business will perform after you've gone. So again, the share charge considerations are about what obstacles there may be to enforcing that share charge. A key importance there is sort of what is the shareholding of the vendors? Is it 100%? Is it minority? Of course, if it's 100%, then it's an easier route to take control again. Practically speaking, you've got to check the articles, make sure there's no blocks in terms of liens, share transfer rights, preemption rights, and of course, if the directors have an ability to block a transfer of shares, but that needs disapplying in the articles. Also, practically speaking, you would want to make sure you take blank signed stock transfer forms, original share certificates, although you can probably rely on a power of attorney these days and the security documents. So that covers sort of really the share side of things, I suppose the final consideration on share charges, if you've got to consider valuation, of course, if you're trying to sell shares, a valuation exercise would have to be undertaken. If I could have the next slide, please. So the next type of security is a debenture security. A single debenture, composite guaranteeing debenture, provides security over all assets. If enforcement is needed, you can appoint a receiver, an administrator, whether it's in court, out of court. And if you enforce the debenture, again, I suppose the other key consideration is value. What is the value of the assets being sold? How easily can they be sold? And what ranking do you have as a secured creditor? If you look at a usual waterfall, proceeds of waterfall clause, application of proceeds clause in the debenture, it's important to understand there will be cash leakage from the business. There'll be the cost of enforcement, preferential creditors. There will be the need to repay any senior lender first. So that all needs to be sort of taken account of as well. Then going into other forms of security, well, there is a legal charge. Now, a legal charge is probably easiest. You appoint a receiver, sell the property, and done and dusted. And that often provides a simple route out, although I rarely come across legal charges as securing deferred consideration. I then turn to a corporate guarantee. The corporate guarantee, I guess, well, sort of going back to the composite guarantee and debenture structure, this is that, but without the debenture, of course. If you've got a guarantor who is financially strong, who you could rely on for the vendors to get comfort, then you might rely on a parent company guarantee. And depending on who that corporate guarantor is, of course, one thing to look at there, of course, is commercial benefit. If there's a guarantee being granted, if it's a company not within the group of the borrower of the company, and then you've got to consider, what the corporate benefit is to that company granting that guarantee. And then moving on from that will be a personal guarantee. Again, this is not something that I've seen regularly, in fact, if at all, in recent years, but it's certainly possible that there could be a personal guarantee granted. I think the thing to consider there is the general rules on personal guarantees, which is understanding the asset position, the financial strength of the guarantor, and probably getting an ILA certificate, an independent legal advice certificate, so that the guarantee can't be challenged. A final thing I want to sort of flag in my little whistle-stop tour of security is, should I take security at all? Sounds a bit counterintuitive, but if a vendor doesn't have security, actually they're not restricted under intercreditor. So they could make demand for payment, they could probably issue a winding up petition against the company and take actions that you probably will be restricted from taking if you signed up to an intercreditor with the senior lender and bank. So but it is something still worth considering whether to take security, but fundamentally, if you don't, then you're alongside all unsecured creditors. That's it for my section. Thank you for listening. If you've got any questions, I won't be available for the session at the end for the Q&A, but if you do want to ask any questions, my details will be on the final slide. And now I would like to pass you over to Trishna. Thank you very much.
Thanks, Richard, and good morning, everyone. Can we have the next slide, Alex? Brilliant, thank you. So I'll just start by introducing myself. My name is Trishna, and I'm one of the employment solicitors here at Brabners. I work quite closely with Mairead on the corporate support work, which might include things like drafting and negotiating consultancy terms, director service agreements, and TUPE considerations. However, for the purpose of today's session, I'll be giving you a bit of a whistle-stop tour on consultancy agreements and the seriousness of entering into a written agreement rather than relying solely on a verbal agreement in these circumstances. Next slide, please. Having a consultant is a valuable commercial tool for any business because the business can still benefit from the skills, the experience and the expertise of the individual, but without the stringent relationship and risks associated with recruiting and retaining them as an employee of the business. A consultancy arrangement may be an attractive option for both the client company and the consultant, partly because of the tax advantages, but also in circumstances where, for example, the seller doesn't quite want a clean break and wishes to remain involved or have some visibility of the business, or where the buyer would like the seller's support for a smooth transition and handover. However, the fact that the arrangement is structured or documented in this way and labelled a consultancy agreement or a contract for services as opposed to a contract of employment will not be conclusive as a matter of employment law or with regard to the individual's tax status. It's the reality of the relationship and how it works in practice that will be scrutinised by the tribunals in assessing this. We see it all too often as part of these transactions that the buyer and the seller will have a good working relationship, and whilst they're negotiating how the deal is to be structured, there may be an agreement for the seller or an employee to remain on as a consultant post-completion. And the parties will want to rely on a simple shaking of the hands. However, if it was the case that we could rely on a simple shaking of the hands, us lawyers wouldn't have a job, because as we know, it's foreseeable that the relationship will come to an end at some point in the future, and it's making sure that both parties are protected in those circumstances and that they are able to have a clean break at that stage. There isn't a legal definition as to what constitutes a consultant, but generally speaking, this will be someone whose experience is engaged on a specific project or a specific matter, or on a self-employed basis where they have most of the control over what it is that they do and when they do it. There are very complicated IR35 rules to consider, which we are not going to go into for the purposes of today's webinar because that's a whole topic in itself. But we would highly recommend seeking legal advice and support when considering a consultancy arrangement and conducting any employment assessments in relation to IR35. Next slide, please. Alex, next slide, please. Thank you. The question of whether the consultant is employed, self-employed, or a worker is important because, among other things, it will determine the basis on which the consultant's income is taxed, whether the client or the business is required to make deductions for income tax and national insurance from the consultant's fees and deduct those at source, whether the consultant will have the benefit of employment rights, such as the right not to be unfairly dismissed, the right to paid sick leave, paid holidays, and whether the individual is owed a common law and a statutory duty in relation to their health and safety as they would from an employer, or whether as an independent contractor they are responsible for their own health and safety. One thing to be mindful of is that irrespective of the individual status, they may still enjoy protection under discrimination legislation, such as the Equality Act 2010. So that's irrespective of whether they're self-employed, or employee, or a worker. HMRC is responsible for determining questions in relation to the individual's tax position, and the employment tribunals are responsible for determining whether an individual is in fact self-employed or an employee for employment law purposes. However, in reality, if the tribunal were to come to a finding that an individual is in fact an employee, then that is more than likely to affect HMRC's determination in respect of tax. Next slide, please. Finally, looking at the consultancy agreement itself, the client and the consultant will usually have a common interest in trying to ensure that the agreement contains as many indicators of self-employed status as possible. So that will include terms like a substitution clause, which we highly recommend. It won't always be suitable, particularly at a senior level, where you're retaining someone's expertise and skills at that senior decision-making level. However, where possible, the right to substitution shows that the individual themselves isn't personally providing services as they would under an employment contract. However, as stated previously, the terms of the consultancy agreement in itself will not be enough to simply determine that someone is a self-employed consultant. And it's actually the relationship in practice and how that operates that will be the key. Which brings me on to considering when you're actually putting the consultancy terms into place and negotiating this as part of the deal, the client should be trying to make sure that the consultancy terms are as different as possible to the terms they may previously have been employed on. Because otherwise, where the nature of the work and the terms are pretty similar or the same, there's an argument that the individual's employment has in fact just continued and that there wasn't any change in their status. So it's really important to scrutinise the relationship with the company and the individual prior to completion, and then how that should operate going forward post completion, and really highlighting those differences. However, a business needs to be aware that when engaging a consultant, they cannot retain as much control or as close supervision as they perhaps would when someone is an employee of the business, unless you negotiated strict control terms under the consultancy agreement. However, that runs the risk that you again lead someone to being an employee rather than a consultant. There is case law that suggests that where a determination is made that an individual is an employee and therefore should be taxed as such, that the burden of that tax should be shared between the employer and the individual. However, we wouldn't recommend relying on the case law itself and ensuring that when negotiating the terms of the consultancy agreement, that indemnities are put in place to ensure that the company is able to claw back any money that they are then responsible paying, that the individual should have paid as part of their tax liabilities. So that's a real whistle-stop tour on consultancy terms, and the same principles apply where an individual is remaining as a director and employing them under a director service agreement, and ensuring that the terms of that agreement are clear, concise, and that they determine the relationship that will go forward in practice. I'll now pass over to Helen to cover the tax considerations of structuring the deal. Thank you.
Thanks, Trishna. Hi, I'm Helen, tax partner at UHY Hacker Young. I work with Dave quite a lot on deal structures, so I'm just going to cover in brief the key tax considerations of some of the points that have been mentioned both by David and Brabners. And could I have the next slide, please? I'm going to focus on structuring the consideration and the focus mainly on deferred consideration and when that is taxable. So the basic starting point is that a chargeable event will occur when the buyer and vendor enter into an unconditional binding contract, which will often be the case. If, on the other hand, the contract is conditional, then the taxable event will occur when the conditions have been met, but it's very extraordinary for that to happen. Case law has shown an example of a conditional contract, which would be a hotelier making a booking with a tour operator on the condition that the Olympic Games will be held in London. Now, until there is confirmation and a decision has been made that the Olympic Games would be held in London, that contract was not conditional. So it doesn't really happen in deal structures, but I just mentioned that for completeness. Deferred consideration itself doesn't make the contract conditional, even if future payments are contingent on future events. So first of all, we'll cover off the technical aspects of it, of deferred consideration, and we'll start off with ascertainable deferred consideration. So broadly, these amounts of future payments, they are actually known at the date of the disposal. So for example, you could have a share deal where the total consideration is £1 million. 500,000 of that is payable on completion, with 250,000 pounds being paid in 2 annual instalments following completion. So here it's a dead cert that the vendor is going to get for 1 million. It's not contingent on any future events, and therefore it's definitely ascertainable. The chargeable event for tax purposes, therefore, is the date of disposal. So the full £1 million would be taxable at that point, the tax being due on the 31st of January, following the end of the tax year in which the disposal takes place. So then we look at what is contingent and ascertainable. So here the amount is known or is capable of being calculated at the date of disposal. So here an example would be £500,000 initial consideration for the shares, with £250,000 being payable on the first anniversary of disposal if profits exceed X amount. and then another £250,000 being payable on the second anniversary if profits exceed X amount. So the consideration is ascertainable because we know in total it will be 1 million, but it is contingent on those profits exceeding a certain amount. In that regard, it's no different really to just ascertainable and non-contingent consideration. The full 1 million would be brought within a capital gains tax computation in the year of disposal. Obviously, no tax would be payable in the future when future payments are received. There is a risk. There's a risk that the future payments could become irrecoverable. And in those circumstances, tax relief is available. It can be claimed on any part of the deferred consideration that becomes irrecoverable. The other point to mention just briefly is when there is deferred consideration, there is a possibility, if certain conditions are met, that the capital gains tax liability may be paid by instalments. I'm not going to go into the detail, but very broadly, if the deferred consideration exceeds a period of 18 months and it goes beyond the normal due date for payment of capital gains tax, then there's a possibility of deferring some of the tax, but there are, like I say, conditions to be met. So moving on to what is unascertainable consideration, and this is a bit trickier because here we have something that is contingent on a future event, for example, future profits of the company. But also the amount is not actually capable of being calculated at the disposal date. So it could be that we have initial consideration that is paid for the shares of £100,000, and then we have 3 further annual payments equal to the excess of the company's profits over £300,000. So we might have forecasts, we might have a good idea based on previous performance, how the direction the company's going in, but we don't actually know what the profits will be, and therefore what the deferred consideration will be. From a technical point of view, the taxpayer in receiving this earnout has received the right, it's a separate asset, it's the right to receive future payments. So it doesn't strictly form part of the sales consideration. But the right, the earnout right has to be valued, and that value can be brought within the original disposal computation, with capital gains tax being payable on the cash received plus the value of the earnout right. That does mean that you're accelerating the tax, but also it means that the proceeds that are brought within the capital gains tax computation can potentially have a claim for business asset disposal relief, which was formerly known as entrepreneurs relief, and is a tax rate of 10% as opposed to 20%. When sums are received in the future, they are liable to capital gains tax as capital sums derived from an asset, and the base cost that can be deducted from those sums is the amount of the value of the earnout right that was included in the original computation. So if future sums are less than the amount already taxed, a loss will arise. That can very broadly be carried back to the year of the sale for offset against the original gain. It's very difficult to value earnouts sometimes, and they can be open to challenge from HM Revenue and Customs. If the value of the earnout can reliably be calculated at the disposal date, then there is the potential to maximise an amount that we can claim business asset disposal relief on. But then we also need to be mindful that there have been changes to business asset disposal relief. The lifetime allowance has been reduced to 1 million. So it all depends on whether or not you've used your lifetime allowance already, what the amount of the overall gain is, and whether it's worth accelerating the tax at that point. So the other point on earnouts, which I've actually put at the bottom of the slides, but I'm going to cover off now, is to do with the risk of any part of the earnout being liable to income tax as employment income. So the idea is, if the vendor is to stay in the business for a period of time to protect the business, then the buyer will offer an earnout. Sometimes the revenue can challenge whether or not that earnout is remuneration if the vendor is not receiving a commercial rate of salary moving forward. Also, if any of the performance targets for the earnout are in any way related personally to the vendor's personal performance, then that could also run the risk of some or all of the earnout being taxed as employment income, the rates being as much as 45%, 2% national insurance contributions for the vendor, as opposed to 10% capital gains tax if business asset disposal relief applies, or 20% capital gains tax if it doesn't apply. There are a few other factors to take into account. So we've got to look at whether or not the value of the earnout reflects the value of the shares. And it's really important that the sale agreement is watertight on demonstrating that the earnout is in connection with the value of the shares. There are other things to consider, but those are broadly the key indicators that HMRC would look at. So moving on to just how how any deferred consideration can be structured. Is it a simple loan? It could be that the buyer issues loan notes in Excel in exchange for some of the shares, so it will provide cash consideration plus an issue of loan notes. With if we have like 1 million deal and we have 500 in cash consideration, there could be 500,000 in loan notes. And going back to the simple loan, all the consideration there is just treated as paid on completion. So that's quite straightforward. But with loan notes, they can be structured as qualifying corporate bonds, QCBs, or non-QCBs. Now, QCBs are exempt from capital gains tax. The gain is actually calculated at the time of exchange, so it's calculated on the disposal, but it's frozen, it's deferred until the QCB is later redeemed, which could be a number of years' time. No business asset disposal relief is available on the deferred gain. However, an election can be made to treat the date of exchange as if it were a disposal, and then that triggers the tax charge. So that would mean paying capital gains tax on the exchange of the loan notes before they're redeemed. So it could be quite a while before. Another downside to QCBs is that if the loan note becomes bad, then no tax relief is available. So we very often advise clients to structure loan notes as non-QCBs. And this normally includes a provision for its conversion or redemption into a foreign currency, because QCBs must be expressed in sterling. Obviously, the paperwork for this has to be carefully reviewed to ensure that they do meet the criteria of being a non-QCB. The gain can be deferred on a share for a non-QCB exchange, so that the gain only crystallises on exemption. And the main benefit of a non-QCB compared to a QCB is that loss relief is available if the loan note turns bad. so you're not paying tax on something that you haven't received. There's no business asset disposal relief on the redemption of the non-QCB. However, similar to a QCB, you can actually make an election to crystallise the gain earlier, so you can crystallise the gain in the year of exchange and claim your business asset disposal relief. But like I say, it all depends on the value of the gain and whether it's worth doing that. So can I have the next slide, please? This is just the final slide, which covers very briefly, David mentioned it earlier, the risk to the capital gains tax regime as we know it. In November 2020, the Office of Tax Simplification, which I'll refer to now as OTS, issued a report to the government following a request from the Chancellor to have a look at the current capital gains tax regime and to look at what was considered to be disparity between capital gains tax rates, which are currently 10%, 20%, with income tax rates, which can be up to 45%. Now, if acted upon by the government, the OTS's recommendations could result in fundamental changes to the regime. Don't have time to go through all of the recommendations that were made, and they're not all particularly relevant to the discussion today around structuring a deal, but the two main points would be whether or not capital gains tax rates and income tax rates may be more closely aligned. There's a possibility that that could happen. We did wonder in the last budget in March 2021 whether anything would be mentioned. We didn't think it would be, I say we as a general profession, because there was just too much focus needed on coronavirus support, but at some point, you know, that support will need to be paid back. So there's a possibility that capital gains tax rates could go up. The other main point that was considered in the OTS's report was addressing boundary issues between capital gains tax and income tax. And one example that I would give that's relevant in the context of this discussion is where an owner of a business retains profits, so builds the profits up, and rather than taking them out as a dividend and paying dividend tax rates of up to 38.1%, they may look at realising the benefit on a sale or liquidation and realising capital gain instead and paying the lower rates of tax. So that's one thing that could possibly be addressed. The other thing that we may see changes in if the OTS's recommendations are acted upon is around business asset disposal relief. We already saw some fundamental changes in a previous budget, which reduced the lifetime allowance from 10 million worth of gains that could qualify for business asset disposal relief to £1 million of gains. It's possible that there could be a change to the regime so that it's more like a retirement relief. So it only the beneficial rate, whether that be 10% or a little bit more, only actually applies on retirement. And there was a recommendation that it only applies to shareholdings of at least 25%, whereas the minimum shareholding under business asset disposal relief to qualify is 5%. So you could see some minority shareholders who cannot claim the beneficial tax rate, but that remains to be seen. There hasn't been really any further guidance. The second report just issued some technical and admin points, so the main report was the first one, which was issued in November 2020. And that's quite a lot to take in. I do appreciate that. So if anybody has any questions either now or if they want to take them offline, I'd be very pleased to answer those. Thank you.
Thanks, Helen. Hopefully that was beneficial to everybody. I appreciate there was an awful lot covered in that hour. Our contact details are coming up on the screen, but I believe a recording of the webinar is going to be circulated to everybody who's registered. Apologies to those who accessed the webinar via their phone. I believe that Richard's session perhaps didn't play on your mobile because it was pre-recorded, so apologies to those people who missed that small session from Richard. One of the questions that's come in that myself and Mary are going to quickly respond to was from Ian, who asked whether EOTs, employee ownership trusts, are still a common deal structure, or do we think that they're just going to be a bit of a current fad? That was Ian Morton. I think they have been more commonplace in recent years, pre-COVID. I think my view, and it'd be interesting to see what Mareed's view is, but I think in the last certainly 12 months, the focus has much more been on private equity and trade. I think EOTs were becoming more popular when there was more liquid funding in the market from the mainstream banks and what have you, and it was quite an elegant way of owners selling their business to their employees. I think because of the valuations that have been achieved in trade sales and the other type of structures that I talked about previously, I haven't seen them as much in the more recent times. Whether that's a combination of the economy, the market, or whether it's just the fact that that current fad is kind of fading out, I don't know. But yeah, I don't know, Mary, if you got any views on that?
I think, yeah, just covering, obviously we didn't mention EOTs. We did cover EOTs briefly in our previous webinar, which discussed exit options, which is why we didn't cover it in this webinar. I do think EOTs will be becoming increasingly popular, and I do think they should be considered as an exit option, because some business owners might be unable to sell as a trade sale, or even unwilling to. And there are a number of advantages which we did cover in our previous webinar, both to the exiting owner, tax advantages, and to the business and employees. So I do think they're becoming an increasingly attractive option to business owners, and I do believe, I don't think it's a fad. I do believe that they will continue to increase. I mean, personally, from at Brabners, we've definitely seen an increase. I think I mean the numbers from the top of my head, but we did complete a number of deals last year during the pandemic as well that were EOT disposals. So I don't think it's a fad. I do think it is an attractive option to business owners and definitely should be considered, but obviously they're not appropriate to everyone. And David, as you said, it definitely does depend on the market. It depends on business valuations and external lending. So they're not for everyone, but something that should be considered.
Great, thanks for that. Whilst I've got you, one of the questions that came in, and conscious of time for everybody, was what's the risk of agreeing a deal without entering into heads of terms from your perspective?
So I'll make this quick. I know I'm conscious of time, but I think the risks are, obviously you can include the binding obligations that I discussed, which is the exclusivity, which is benefit for the buyer, and confidentiality for benefit for the seller. If the heads of terms aren't entered into, we would advise as a minimum for a non-disclosure agreement to be entered into, and if acting for the buyer, then an exclusivity agreement. That they are the main risks, but I do think they just assist all the parties. It creates a framework. You can include a timetable. So yeah, they are beneficial, but as a minimum, you should definitely enter into a non-disclosure and exclusivity.
Yeah, and I think as a final point on that, from our perspective, I think our approach is always to try and agree and negotiate very detailed heads of terms. If you don't have them in place, if it's just a straightforward LOI, is there really a commitment there? Is there really the detail that everybody understands what the deal is structured around and what values are being placed on what? So I think just to add points there, I think it's absolutely critical.
Yeah.
That brings the webinar to a close. I think thank you from Brabners, thank you from UHY. I hope it's been a worthwhile hour of your time. As mentioned before, our contact details are all available on the slides that will be circulated, and I'm sure all of us would be delighted to hear from anybody if there was anything you'd like to follow up. So enjoy the rest of your day, and we'll hopefully speak to you all soon. Thank you.
Thanks, everyone.
Thank you.